Hey guys, welcome back to my channel. It's CJ Investing, and I'm back with you with another video. And today I'm just doing my top 3 stocks, my top 3 dividend growth stocks. My first stock is going to be Intel. So Intel, as of trading on Monday, was $29.44. As you can see, this is the chart. The 5-year chart. As you can see, it came down quite a bit. It's been on a downtrend from 2021 till now, so it's at quite a discount in my opinion. And as you can see, the 52-week range, the high was $56.28, the low is $24.59, and it's closer to that 52-week low. So that's what you want to see when you're looking for undervalued dividend stocks. As everything money says, that's one of the first metrics you want to look at when you're determining whether you should look further into the stock, the 52-week low. As you can see, the price to earnings ratio is trading at 9. This is some news here. These are all some benefits of Fidelity. By the way, they just updated the application to better their experience for their users. As you can see, the Terrace estimate is that it's undervalued. Their fair value is $33.70, which I think it should be valued much higher than that, but that's just my opinion. As you can see, some metrics down here, 43.4% is data center group. This is where the revenue comes from. 33.7% is client computing group, 11.6% all others, 11.4% internet of things group. 1 rating a buy, about 6 neutral, and 1 sell. So it just tells you a little bit about Intel's profile. Intel engages in the design, manufacture, and sale of computing products and technologies worldwide. The company operates through CCG, DCG, IOTG, Mobileye, NSSG, PSG, and all other segments. It offers platform products such as central processing units and chipsets, and system-on-chip and multi-chip packages, and non-platform or adjacent products, including accelerators, board and systems, connectivity products, graphics, and memory and storage products. That's a little bit about Intel. The company was incorporated in 1968 and is headquartered in Santa Clara, California. So it's in the semiconductors and semiconductor equipment industry, information technology sector. Revenue as of September 30th, 2022 was $69.54 billion. This is something that they added to Fidelity, where you can see their earnings. Their earnings have declined quite a bit. You know, they've been affected by the semiconductor shortage, and they've been they've been doing some work, investing more into their business, working on their facilities. But right now they're in a kind of restructuring place of their life cycle. They just released their new chips, their brand new chips, as of recently, and the stock price went up slightly because of that, but they're still in the rebuilding phase. Like, their stock price hasn't recovered to the highs that it was in the early 2000s, which really says something because the business has grown a lot since then. So this is one of the things you gotta just look at for yourself and determine what's a good value, what's a good entry price, what are you willing to pay for a stock like this, because in my opinion, it's a buy right now. And I look for things like this. As you can see, the dividend payout ratio is 45.20%, which is really low. They have plenty of room for growth. And the dividend yield is 4.96%, which is really high. Dividend rate of 36 cents per share. All right, that was Intel. So our next stock is going to be Qualcomm. So it's ticker symbol QCOM, ticker symbol QCOM. So as you can see, this is the 5-year chart. It's grown. Unlike Intel, it's grown over the 5 years a little bit of a dip from 2021. As you can see, you see a trend, maybe not as aggressive as Intel, where it's declined quite a bit from 2021, but 2021 is the highest for a lot of these companies because it's where the market was very overvalued. We were recovering from the pandemic the previous year, and the market just shot up from then, and it didn't come down to like late 2021 or mid 2021, and it's been on a downward trend since. So this is another undervalued company in my opinion. As you can see, the P ratio is at 10, slightly higher than Intel, but that's still very cheap, especially in the semiconductor industry when you have companies like AVGO trading at like a 20 something. I think Texas Instruments trading at like a 18 or something like that. As you can see, the earnings per share is like 11.42, which is good. The 52-week range for Qualcomm is from a high of 192.10 cents to 101.93 cents. As you can see, it's much closer to the 52-week low than it is the high, which is what you want to see when you're looking at investing in these companies. As you can see, some news. Apple set to bring radical transformation in chip industry with plan to ditch Broadcom, Qualcomm as suppliers report. So that's something you need to keep in mind. That's something to be aware of. You want to always do your due diligence. You want to always assess your risk. What are the risks with this company? One of the risks with this company, as well as Broadcom and even Skyward Solutions, is that they are dependent on Apple for a source of their revenue, and Apple provides big revenue for these type of companies. But with Qualcomm, it's pretty diversified. They have plenty of customers, so they're not over reliant on Apple. As I think losing the customer Apple will definitely affect their profitability, but it won't be like a huge hit with somebody like Skyward Solution that solely depends on Apple for its revenue. So that's one thing to keep in mind. Terra's valuation is $154.65. That's fair value. It's saying it's undervalued right now. So 75.5% of the revenue comes from mobile device chipsets, 24.1% mobile device royalties, 0.4% other initiatives. So as we go further on, 2 analysts have it at the buy, 1 outperformed, 4 neutral, 1 sell. So Qualcomm Incorporated engages in development and commercializations of foundational technology for the wireless industry. It operates through 3 segments: Qualcomm CDMA Technologies, Qualcomm Technology Licensing, Qualcomm Strategic Initiatives. The QCT segment develops and supplies integrated circuits and system software based on 3G, 4G, 5G, and other technologies for use in wireless voice and data communications, networking, application processing, multimedia, and global positioning system products. A little bit about Qualcomm. The company was incorporated in 1985 and is headquartered in San Diego, California. So the sector, information technology, the industry, semiconductors and semiconductor equipment. Revenue was $44.20 billion, which is pretty good. As you can see, their earnings have been going up for the most part, except for really Q3 2022, as they're gonna have quarters where they do better than other quarters. That's with any company. So 5% EPS growth from last quarter to this quarter, 75 cents dividend rate, Dividend yield is 2.57%, not bad. Payout ratio is 26.29%, which is extremely good. They have plenty of room for dividend growth, and they're in no risk to cut their dividend no time soon, no time in the near future. So that's something to keep aware of. Their annual dividend is $3. So another great company. This company is it's not in a bad place at all. So if you want to get into it, I don't think it's at a bad price to get into it at. But I'm not a financial advisor. Remember to do your own due diligence before investing. So our last company is going to be T. Rowe Price. And these are not in a specific order, really. I'm just trying to get them out there. So T. Rowe Price, ticker symbol TROW. So the 5-year chart, it has declined quite a bit, probably from 2021. Yep, I was right. That's when the market was extremely overvalued, the highest it's been in a while. So it was at like highs of like 222, and now it's at 117.20 cents. 52-week range, the highs was like 193.82, lows is like 93.53, and it's much closer to its lows than it is highs. So the price to earnings ratio is 13.46. It seems like I'm going up on every stock with their price to earnings ratio, but I'm not doing it on purpose. So, but these are all undervalued stocks. Earnings per share, $8.7. So trades on the NASDAQ. And that's another thing to look at. If it's like, say if it was on a Dow Jones, you have to look at the entire index. Is the index considered kind of overvalued? The Dow Jones is pretty high up there compared to the NASDAQ, which has sold up quite a bit. So you want to also look at that. You want to look at your indexes that it's trading on to determine, maybe I should wait till it comes down a little bit. Maybe the entire index comes down a little bit because it seems a little high compared to the recent years. So that's another thing to look at, which I didn't think of until, recently. Because I'm still learning. I've been in the market for about 2 years. It's going on 3 years. I got in at February 2020, right before the pandemic started. So analyst ratings 4.6. You got 7 rating in the neutral. That's it. T. Rowe Price Group is a publicly owned investment manager. The firm provides its services to individual institutional investors, retirement plans, financial intermediaries, and institution. It launches and manages equity and fixed income mutual funds. The firm invests in public equity and fixed income markets across the globe. So y'all probably know this one. If you have a retirement account, you may have a retirement account in this account. It's all over the world. You probably know T. Rowe Price, or you know BlackRock, one of those retirement companies. But they're very well known, very safe in my opinion. Safe investments, safe place to park your money. But so obviously it's in the financial sector, capital markets industry. Revenue was $6.93 billion, and as you can see, their earnings, it has declined a little bit, but they maybe missed on their earnings maybe three times as in the recent years, and they've beat on 3 times. So as you can see, the dividend rate is $1.20. The dividend yield is 4.10%, which is really good. That's a really nice yield. Payout ratio is 55.05%, which is good as well. not as low as I think Qualcomm, but it's still a great reel. It's right in that golden range, right in that perfect range where you want a payout ratio to be, but they still have enough. They're paying out enough, and they still have enough room to grow their dividend. So annualized dividend is $4.80. So these are some of the financials. So this is Intel's financials. Move on to T. Rowe Price financials. T. Rowe Price has great margins. Total revenue 6.9 billion. Cost of revenue 2.9 billion. Gross profit $4 billion. So they're keeping a majority of the money that they make, which their margins are pretty high, which is one of the things you want to look at. One of the things I didn't look at with the other company is if they're decreasing shares, which T. Rowe Price is decreasing the shares, went from 235 to 228 to 226. That's awesome. That's what you want to see. As you can see, their revenue, man, it's going almost straight up. Earnings going almost straight up. This is a beautiful balance sheet coming from a company. You want to look at these type of things. Cash 1.5 billion. Total assets 12.5 billion. To total liabilities 2.2 billion. Barely any liabilities really. They can pay that off easily with some of their assets and have some left over. Free cash flow went from 1.3 to 1.7 to 3.2. That's really good. And our last company, I think was Qualcomm. So we go to their financials. And Qualcomm has great margins as well. Total revenue of 44.2 billion. Cost of revenue 18.6 billion. Gross profit is 25.5 billion. So they have great margins. They have really, I think their margins for Qualcomm is like in the 40s, high 30s, low 40s. The margins for all the other companies, I think T. Rowe Price margins was like mid to high 20s, and Intel's margins was either in the high teens, maybe low 20s. Don't quote me on that though. They are decreasing their share from 1.2 to 1.1 to 1.31. They're decreasing their shares, which is what you want to see because you don't want to be diluted as a shareholder. Decreasing your ownership in the company. So you want to watch that because companies will do that. They will dilute you quietly if you're not paying attention. Total cash they have on hand, plenty of cash, 6.3 billion in cash. As you can see, the total assets 49 billion versus the total liabilities of 31 billion, which is higher than I would like to see, but they can pay it off and they have plenty of cash on hand to pay off. Let me see, 6.3. They could pay off a good chunk of their long-term debt with the cash they have on hand. Plenty of cash. So if they ever get in trouble, they can resort to that. So we look at free cash flow. Went from 6.3 billion to 4.4 billion to 8.6 billion to 6.8 billion. So it's kind of been all over the place. But they pay quite a bit. It looks like they pay like an even amount in between dividends and common stock when they do repurchases, which it's good that they have a strategy. They're paying quite a bit out in dividends and common stock. So they're really dedicating their money back into their shareholders and they're rewarding them. So I'm not worried about Qualcomm. They're in a good place in terms of their financial. As you can see, this is Intel. okay, their normal margins is around low 20s. Their margin as of the recent quarter was like 6%, so I was off on that. I apologize. They've been in the rough spot, which gives investors the opportunity to invest in their company at cheap prices. So let's look at T Rowe stock, trading at 13. As you can see, T Rowe stock's profit margins 24.2%. It's kind of remained, and it's been up into the high 30s percents of their profit margin. So they're making plenty of money. This is a company that you don't have to worry about. You don't want to compare too much about their revenue. Their revenue is only 1.59 billion, but they're keeping the most of that. So opposed to a company that's making like 100 billion, and they're only keeping like 1% or like 10% or something. These companies are able to keep more of their money. You don't want to just look at revenue alone. You want to look at their margins. It shows you how much they're keeping in profit. It doesn't matter if they're making 100 trillion if they're only keeping 1% of it. So that's one thing you want to take a look at when you're looking to invest in these companies as well. Qualcomm. So their profit margins is around 25% as of recently. It's been up as high as mid-30s. Another very profitable company. So their earnings per share been in the twos. It's been in the low threes, $3. Revenue has been 10, 11, been around 10, 11 billion. So these are all great companies that you probably need to take a look at. They're all undervalued, and they're all going to do well in 2023, I believe. So thank y'all for watching. Hope y'all have a blessed rest of y'all day, and I'm out of here. Peace.